Hi, everyone. This is Jason Barack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. She is one of the top global macro experts on the planet. She knows a lot about everything, including energy, commodities, value investing, and global macro. Lyn Alden, thank you for joining me.
Thanks for having me back. Happy to be here.
So when the Fed increased interest rates again, another 25 basis points, there were more aggressive people at the Fed who thought they should have increased by 50. In your opinion, what type of damage has the Fed rate hikes done yet? And is a lot of this damage priced in yet?
So far, it's affected the most interest rate sensitive industries. So real estate is the obvious one. And tech is obviously another one, but the interest rate catalyst is less clear to people. So basically, a lot of these unprofitable tech companies, instead of earning money from selling their product or service, they earn their money from selling equity, essentially, or basically they're augmenting their unprofitability by constantly selling equity. And so that's really dependent on high valuations. They also often, pay their employees in a lot of equity. And so when you have higher rates, you now have a higher hurdle rate, a higher discount rate. And so those types of, kind of longer term unprofitable, types of companies get much lower equity valuations. And that really hurts their business model of selling all that equity and not really having to generate a profit. And so what they have to do is then they have to basically raise prices to try to, have a, maybe be profitable, but at least lose less money per sale. So they raise prices, but then that slows down their growth, and then that further hurts their equity valuation. And so basically either industries that are very levered, like real estate, or ones that are very, very highly valued and reliant on that equity issuance, like tech, specifically unprofitable tech, those have obviously been more heavily impacted than other areas. Whereas, for example, things like travel companies, services, that kind of thing, they've generally held up better so far because they're less directly interest rate sensitive. Now, the risk is that the longer that these higher interest rates stay in play, more and more existing debt refinances at those higher rates. So it's not as though, just because the Fed raised rates doesn't mean that everybody's like mortgage rates or corporate bond rates go up, because a lot of that is fixed rate debt. And so quarter after quarter, some of that comes due, some of that gets refinanced at these higher rates, which means that interest expense eats into the profit. In addition, you have people that work in real estate or work in tech. They have to then spend less. They lost their job, or they're not getting a bonus, whatever the case may be, and so they're spending less on other parts of the economy, and that can start to ripple through things over time. And so I think we're kind of in a state of two economies right now. There's interest rate sensitive ones that have been hurt pretty bad. Basically, if you just looked at those, they're in a recession. And there's other ones that were kind of held down for a number of years, like travel, for example, that are still holding up pretty strong, travel and restaurants, and they're having less signs of a problem yet. And so I think that the key is to watch how more and more of this debt comes due at a higher rate. Another key is to look at real interest rates. So just because interest rates are going up doesn't always mean that real interest rates are going up. It does mean that lately, but we also are seeing a resurgence of inflation over the past month or so. And so that's something we have to watch as well.
I mean, consumer spending hasn't collapsed, but I would argue a lot of it is due to inflation. So the spending looks about the same as it was in past years, but a lot of that is because of higher inflation rate, because we just see the savings rate being drained from a lot of consumers who are not earning six-figure incomes or higher, and we're just seeing credit card debt spiking. So it looks to me, if you look at savings collapsing, credit card debt spiking almost to $1 trillion, I think, when we're recording this interview on Wednesday, March 1st, 2023, it looks like that's stagflation, and a lot of consumers, to try to maintain their standard of living for who knows how long, maybe 6 months, 12 months, or a little bit longer than that, they're trying to put a lot of their standard of living with the inflation cost increases and stagflation and shrinkflation onto a credit card instead.
That's essentially what we're seeing. Yeah, if you look at real retail sales, they've been basically flat since spring 2021. And so, we're over a year and a half of basically chopping along sideways in terms of real sales. They're higher nominally in significant part because of the inflation component. And that's an overall trend to be aware of is that there's going to be big differences between nominal numbers and real numbers because that inflation component is so large. And so in many ways, it looks like either a stagflationary type of situation or almost like an emerging market style recession, where often if you look at nominal currency terms of what's going on in those emerging markets during, bear markets, a lot of nominal things are still going up because their currency is devaluing. And so that's not a situation we normally see in developed markets, at least not for quite a while. But that's kind of the situation we find ourselves in. A lot of the disinflationary forces over the past 40 years have been reduced or removed at recent times. Another thing to look at is basically that, the government deficit in the United States is still running at something like a $1.4 trillion annualized rate at the moment. Like if you look at just forward predictions. And it's pretty challenging to have a nominal recession when you have such stimulus basically pouring into the economy like that. But you can, of course, still get real recessions. Basically, when you adjust everything for inflation, which is really how you have to do it. That's where we're kind of at stall speed. So if you look at Purchasing Managers Index, if you look at most economic indicators and rate of change terms, they're not very good, and you really just have things held up by nominal numbers, and you haven't really had the overall labor market crack yet. Although around the margins there are weaknesses. So, for example, overtime hours have been declining. Temporary help services have been declining. These are some of the more volatile leading indicators for the broader labor market. And so, it's definitely softening around the margins, and it's really not looking good for overall like real GDP numbers this year.
I think Walmart and Target also said recently that they notice a lot more six-figure earners that were shopping at Walmart and Target. So the consumer, where they can, I guess, is trying to trade down a lot. So substitution with higher costs, with inflation and shrinkflation, the consumer, even if they're earning a six figure still, is still trying to trade down.
Yeah, and that's also, six figures doesn't buy what six figures bought years ago, right? I mean, if basically if mortgage rates are way higher, if rents are way higher, if food costs are way higher, if airplane tickets are way higher, like 100,000 now is like what 120,000 used to be, for example. Especially when they're at a higher tax bracket as well. And so I'm not surprised to see that, especially that kind of middle class or upper middle class area really gets squeezed because they have all the healthcare costs, they have all the education costs, saving up for college. In many ways, they are pretty squeezed, and so they do have to be careful with their spending, just like anyone else.
So with interest rates, and you talked about this, without specifically saying it, there's a lag. I've interviewed a lot of other experts, and some have said that it's 6 months. Some have said it's 12, 18. I guess it really depends on the recession and how interest rate sensitive the asset prices are or these industries. But a lot of these large cap corporations, Lyn, over the last almost 15 years, the Fed basically, I would call it Pavlovian, where they were kind of training these senior executives at these large cap companies, these S&P 500 companies, that we're going to keep interest rates low with quantitative easing, keep interest rates artificially low. And so a lot of these companies just borrowed more and more debt for share buybacks. And now you have a situation where the Fed has raised interest rates a lot in the last 18 months, a very quick rate hike pace, I guess, to try to fight inflation is one of the main reasons. But now we're going to start seeing that lag effect where the interest payments on the debt, all this debt accumulated, and you talked about some of the debt is fixed rate, but not all of it is fixed rate. And that's going to start to affect a lot of the balance sheets of these large companies, especially dividends. We just had in the last couple of days, Intel just announced a 65% dividend cut.
Yeah, I think you're going to see just a lot of stagnation in companies that don't have a lot of pricing power. So there are individual companies that might be doing very well. They're able to raise prices. They're able to keep growing in that environment. But they're generally in the minority. A lot of them, because you have a consumer that's not as strong as they were a year ago by many metrics. They're less able to raise prices. If they do raise prices, they have trouble with volumes. Their own expenses are going up quite considerably due to higher wages and higher interest expense, and so that does squeeze a lot of them. And a lot of them were trading at pretty high valuations until this past year when they let out a lot of steam. And so I do think that's going to be an ongoing concern some industries more than others. I mean, for example, I think, certain healthcare companies, certain energy pipelines that, there are certain areas that are less sensitive to that sort of thing. But there are a lot of industries on multiple different sectors that are very resulting, like basically having that issue. And I think what makes this cycle a little bit different than prior cycles is that this is the first time where the interest expense is really becoming pretty meaningful for the federal government as well. And so basically you had this period where, for decades now, you had rising debt as a percentage of GDP, but it was offset by the fact that you had lower interest rates. And so the interest expense was not going up relative to GDP, and even not going up that much in absolute terms. But now you're in that period where debt as a percentage of GDP is going up, and you have interest rates that are flat to sideways now. And so that's starting to compound into higher and higher interest expense for the federal government. And that basically is money pouring into the economy. That's basically a deficit for the government is a surplus for the private sector, which is in many contexts quite inflationary. And so that basically you have a lot of these levered companies are having their income eat up by interest expense. And then you also have the federal government just kind of pouring more money into the system in large part because of their higher interest expense.
And because of the higher consumer price index, you have a lot of state and local governments, the transfer payments, which are Social Security or other types of people, welfare or other systemic payments that the government has agreed to give out. The cost of living adjustments. And I was just seeing over the last week or two that these cost of living adjustments are starting to kick in. So these governments are going to have to pay out even more in inflation adjusted transfer payments too.
Yeah, all of those. Basically, the Social Security is inflation adjusting. The Medicare at the end of the day has to buy goods and services, basically medical goods and services. So those are basically inflation adjusting, and so that's the challenge that they find themselves in. And so you have annualized interest expense for the federal government went up from something like 600 billion at the start of 2022. Now we're approaching like what is it, like 850
It's
billion.
almost 900, yeah.
Yeah, and it's still rising. And then also there's another factor that the Federal Reserve used to pay about $100 billion per year in remittances to the Treasury. So basically the way that the law works around the Federal Reserve is that, they have assets, they have liabilities. They're like most banks, their assets pay a higher interest rate on average than their liabilities. So they earn basically an interest spread. But because they're the central bank, they're required to pay after expenses and after a dividend, they have to pay their excess income to the federal government. But starting in September of last year, September 2022, they raised their interest rates so quickly that for the first time in modern history, the interest rate on their liabilities exceeds the interest rate on their assets. And so the Federal Reserve is operating at a loss. And so they're no longer sending money to the Treasury. And so the Treasury just lost a $100 billion roughly annual income source from the Fed, in addition to this higher cost of interest expense. And so these days $100 billion doesn't even sound like a lot to people, but for context, that's 4 NASA's worth of income, right? That's basically NASA is something like $25 billion a year in expenses, and they just lost $100 billion a year Fed remittance income. So that's another factor that compounds onto this, and this is just larger deficits, and a lot of that just keeps pouring money into the private sector, especially once we get past the debt ceiling impasse.
Yeah, I don't see the Federal Reserve's official balance sheet shrinking that much going forward. Eventually, at some point, it's going to have to do 180, or they're going to have to move a lot more off balance sheet into these legalized special purpose vehicles as of March 2020. But you brought up the Fed, the interest payments. If the Fed was a publicly traded company, so you could look at their financials, they were audited, you would say that their business is deeply cash flow negative right now because of those interest rate increases. They're paying out to the banks now on the interest on excess reserves, IOER, which is supposedly where all that capital was parked during the QE programs. The Fed was like, oh, it's not going to go into the real economy. The banks are going to park it at IOER and it's going to be sterilized there. Well, now with these higher interest rates, the Fed is paying out excessive sums of interest to IOER. Same thing for reverse repo. So there's over 2 trillion parked at reverse repo at a very high interest rate too.
Yeah, if you look at the Fed, if it were a private entity, it would be insolvent in a few weeks. So basically, they now have 36 billion in accumulated losses, and they only have something like 41 billion in official equity, and so they're basically their tangible equity is about to go negative, but because of accounting kind of gimmicks that they can do, those losses don't get marked to market. They just get stored up as deferred assets. And the way that works is that if the Fed ever becomes profitable again, rather than resuming their remittances to the Treasury right away, they get to pay back the hole that they dug themselves in first. And so basically, they get to list that as like not a big deal. And so unlike a normal bank, they don't go bankrupt the second that they have like negative tangible equity, and instead they just kind of operate in that weird gray zone of being really, when you dig into it, they're insolvent, but because they operate a little bit different than the normal bank, they just get to keep operating anyway, and it really just gets pushed over to the Treasury, who just loses that income source. And so they have a couple different ways that they can handle this. I mean, some of those reverse repos can get pulled back into the banking system. The easiest way to do that is the Treasury could issue more short-term debt, but that's also higher cost debt, ironically, right now because the yield curve's inverted. Or they can, over time, we're generally seeing that banks' deposits interest rates are inching up. So one of the reasons right now, I mean, basically, if you wanted to hold cash, one of the smarter ways to do it is either to buy T-bills or to put it in money markets, because money markets are putting it into those reverse repos and collecting that higher yield. Whereas one of the worst places to have it is in a normal bank account, like a checking account, a savings account. Basically these, because they're lower yielding. But over time, I think we're seeing that spread narrow a little bit, where you're going to start to see bank deposit rates inch higher. And that can suck some of the capital out of the reverse repo market. But yeah, we'll see how far they can get with the balance sheet reduction. That reverse repo is a little bit of a well that they have to draw from. But yeah, they find themselves in kind of a challenging position here.
Yeah, I remember when they had way over $1 trillion at the Treasury General account, but I think that was drained almost all the way down pretty quickly after Biden got into the White House.
Yeah, that's been so. And actually, the debt ceiling impacts this. So, if you looked at last year, if you look at 2022, you had the Federal Reserve start to draw down their balance sheet, so that was pulling liquidity out of the market. But then by the end of the year, you started to see the Treasury General account go down, and so that was one of the factors that allowed for the markets to rally by the end of last year. And they've been kind of in this like more sideways band ever since. And ironically, the debt ceiling is kind of good for liquidity in the near term, because it as long as that debt ceiling is in place, one of the extraordinary measures that the Treasury Department has to do is they have to start drawing down their general cash account. It's kind of like how if you lost your income source but you still had expenses and you had a little bit of savings, you'd have to start drawing down your savings to keep paying your expenses, at least until those savings ran out. And that's essentially what the Treasury is forced to do until roughly the end of Q2 of this year, is that they pretty much have to draw down their cash balance. And that's actually pretty good for liquidity. So you have, on one hand, you have the Fed pulling liquidity out of the market by drawing down their balance sheet. On the other hand, you have the Treasury kind of gradually pushing liquidity into the market. And so it's kind of like a standoff for the next several months. And once the Treasury General account gets drawn down very, very low, if there's some sort of debt ceiling resolution, and then they try to refill their cash account by issuing debt, that's where it could be very, very negative for liquidity. And so that would probably be a big problem for markets later this year.
Do you think there's demand for all these treasuries once the US Treasury is allowed to start selling a lot more debt? Because it seems to me that the normal buyers of treasuries, at least for the last 15 or 20 years, said these are the large countries that recycle their trade surpluses into foreign exchange reserves. So your Chinas, your Germanys, your Japans, they're not the normal buyers anymore of treasuries in size that they would have been in the past.
Yeah, there's a handful of different buying segments they have to analyze separately. So one is, that strategically you don't see a lot of international buying. Ever since 2013, China declared it was no longer in their interest to keep accumulating treasuries. You don't really see it from say, for example, the Saudi Arabia or other like OPEC nations either. You don't really see that kind of foreign accumulation around the margins. Whenever you have a weaker dollar period, you usually see a little bit of reserve accumulation. Whenever you have like one of those like strong dollar periods, you generally see a trimming of reserves. And so basically, you don't have a lot of foreign demand at the moment. Banks are not really buying either, like domestic banks. And so right now, most of the demand is being absorbed by like, money, like basically like mutual funds and other kind of like non-bank domestic buyers. And yeah, I think the case for that
is that,
go
sorry
ahead.
to interrupt you, is that institutional buying? So are those like the bond funds where like if someone has their retirement account and they can allocate their retirement account capital to a bond fund and that bond fund's buying treasuries?
Yeah, pretty much. And you have a couple factors there. One, you have some rebalancing, right? So you have people trimming equities and buying bonds, and other people are basically looking around and saying, well, like the things we discussed before. If you're looking at Intel facing a dividend cut, if you're looking at recession indicators, you have some percentage of the market that does want to then pile into treasuries, especially because they have higher rates than bank accounts. And so they can get short-term treasuries and get a higher rate, way higher rate than bank accounts. And so basically, as long as you have a decelerating economic environment, there is some domestic appetite for the treasuries. But when you do the math on the years ahead of just how big the deficits are going to be, especially if you have another growth cycle ahead, and so basically people are not, they want to be in equities at that point. It is pretty hard to finance those deficits, and as long as the international situation continues to overall favor reserve diversification and gold instead of treasuries, which I as a base case I expect to continue. I do think probably in the years ahead you'll have to see either the Federal Reserve continue its treasury accumulation, or various regulations that put more of it onto the commercial banking sector. This could be things like SLR adjustments and things like that.
So you brought up how the OPEC countries aren't recycling their enormous oil profits that they've had the last couple of years into U.S. treasuries. I think they're buying gold in tonnage, because in the past, during the 1970s, where oil was doing very, very well, a lot of those countries, and the Hunt brothers actually copied this strategy from their friends who are running the oil companies in Saudi Arabia and the OPEC countries. They were buying physical gold and silver. So I think a lot of the gold purchases, and we've seen just enormous amounts of data, we've seen record amounts of gold purchases by governments and central banks in 2022. I think a lot of that was oil reserves that were recycled too.
I mean, that's a big component of it. It's also just like non-treasury, non-gold assets, things like equity, right? So for example, Saudi has like their Vision Fund. Basically, instead of just piling it into treasuries, you've seen some of these countries basically put it into their sovereign wealth funds, which are generally more equity focused. And so it really depends on the country in question. Some of them it's gold, some of them is private equity, some of them is publicly traded equities. And it's kind of like how if you're a portfolio investor, and you have high inflation and yields on treasuries are not high enough, some of them go out and they buy other assets. And yeah, for some of them, gold makes sense. For others, they like the equity or the private equity or some sort of domestic investment in their economy, or a strategic investment. Like partnering with an ally and building like an oil refinery, that kind of thing.
So I want to transition now to Japan. You were talking about the U.S. Treasury and financing problems, and really the financing problems get kind of out of whack when there's not enough demand for government bonds, and then interest payments start to skyrocket. And then the government, after many years of yield curve control, or people have labeled it Japanification, the government can't afford interest payments on the rapidly growing national debt. And it comes basically like the government and the central bank are trapped. So do you think that Japan has finally gotten towards the end game for yield curve control?
Well, I think it's firmly in the yield curve control area. I mean, if you look back at the 40s, yield curve control lasted until a significant percentage of the debt was kind of inflated away. And Japan hasn't really started that process yet. I mean, their debt is still very, very high relative to their economy. But they've kind of been in a weird situation where like they've partially deleveraged their private sector in the sense that their corporations have increased their cash quite a bit over the years, and so their corporate debt to GDP has gone down somewhat, but their net debt went down even more because of that accumulation of cash. And so really their private sector is not as bad as it used to be, but it's all on the public balance sheet now. They have well over 200% debt to GDP in the public sector, so they can't afford high interest rates. And so they're ahead of the curve in terms of the global, all the different countries, because they're the most aged country, because they're the most indebted country at the public level. They're stuck in this like firm yield curve control environment. And so they're kind of stuck in that situation. Now, one thing that's been kind of funny recently is that because Japan's money supply is not growing super quickly, and because they have, not a huge, like say, current account deficit like a lot of other countries do, their overall domestic inflation rate has not been very high, and so actually their real yields are not really any worse than you see in like Europe or the United States, even though their interest rates, their nominal interest rates are lower, and so I think they're going to keep muddling through in the way that they have been, where they're just going to keep yields low, below their inflation rate. So anyone holding yen deposits, anyone holding yen denominated bonds are just going to keep getting devalued on a purchasing power basis. People are better off being in Japanese equities if they want to have exposure to the Japanese market. And other than that, they can go elsewhere to areas that are not facing that type of financial repression.
I interviewed former top hedge fund manager, Bill Fleckenstein yesterday, and he was telling me that the new governor at the Bank of Japan is going to end yield curve control. It's going to allow interest rates to rise. The yen's going to strengthen. It's going to have a rally. Maybe it has a temporary rally, in my opinion. So we're kind of disagreeing how long that rally is going to last. But I see a math problem there, and he didn't want to admit that there was a serious math problem there where they really couldn't allow interest rates to rise that much, because once you get into the yield curve control and Japanification game, and Japan's been doing it longer than anyone else, I mean, at this point, can they even really afford 2% or 3% interest rates for a long period of time, for more than a couple of months?
It depends on whether they're willing to pay the cost for it. And it gets to the ironic level where, normally when we think of high inflation, we think of, okay, raise rates to quell that inflation. But if you have very, very high public debt to GDP and you raise rates, you blow out the government deficit, because now you're paying a much higher average interest rate on that debt. Especially if you raise rates for long enough that more and more of that debt matures and refinances at that higher rate, and you blow out your deficits, and that can actually add to inflation, because you're adding to money supply, because you're paying out those much larger deficits that are driven by that interest expense. And so Japan could get into a situation where they get a little bit more hawkish, like maybe he said, they do get a temporary yen strengthening. But then the problem is, if they're paying a higher interest rate on their debt, that can actually exacerbate Japanese inflation, right? Because that can actually be a source of money creation for the Japanese economy. They've had, part of the reason that their inflation, the key reasons that their inflation has been so low relative to the rest of the world over the past, 10, 20 years, is because they've had very slow, broad money supply growth. Even though their monetary base went vertical, right? Their Bank of Japan balance sheet just like soared. That's not translated into rapid money supply, like broad money supply growth.
Didn't they also export a lot of this monetary inflation? So a lot of Japanese pension funds and banks were investing all that excess capital creation. They were investing it outside of Japan. So there were a lot of different ways. You had the yen carry trade, which they were encouraging a lot of American and other foreign hedge fund managers to borrow in yen and then invest outside of Japan. So there was a lot of like creative financing ways they were doing to try to limit the inflation.
Yep, exactly. And now what's going to happen, basically, it looks like, is that if they stay low and you have a commodity bull run, then there's a very strong incentive to basically short the yen. Basically, you borrow yen and you buy like commodities or anything else with it, right? So then you can get money supply growth from that. Or if they try to raise rates to prevent that, then they get a fiscal spiral. They get more and more inflation and money creation from higher and higher interest expense. And so I essentially think that they're trapped, that they're basically going to have higher inflation than people have become to expect from Japan going forward on kind of a regular basis.
Yeah, I agree. It looks like best case scenario for them is worse stagflation, and they're going to have a lot higher interest payments on their debt.
Yeah, one of the key advantages, I mean, they have two overall positives. One is that they have a positive net international investment position due to years of accumulated trade surpluses. And so they own more foreign assets than foreigners own of their assets. So they do have foreign assets they can sell to repatriate capital. That's one of their
Well,
strengths.
haven't
Uh,
they been doing that? Sorry to interrupt you. Haven't they've been doing that a lot lately, right? They were at one point they were selling over $80 billion a month in US Treasuries.
Yes, but they still have a very, very large net international investment position. So that's not even that's like a tip of the iceberg for what they have. So that they still have that option. And then two, they generally have less polarized politics than the Europe or North America. And so basically they have just that's a strength that they have compared to their obviously their biggest disadvantages are their public debt and their demographic situation, among others.
Well, also they a lot of their companies like Toyota, Honda, some of the other manufacturers, they've opened up factories in the United States. So those companies are earning profit still, but they're not with Japanese workers. Most of them are Americans now.
Yeah, and I mean the funny thing is a lot of cases because their population is not growing and they have low like unemployment rates domestically. For them, maximizing like domestic labor is not their key, and instead they're kind of like nationwide kind of top down goal, especially if you look at those trading companies, like those ones that Warren Buffett bought. A lot of their focus is on making sure that their overall economy keeps getting the commodities it needs and keeps getting income from those like multinational companies, because that's part of what stabilizes the yen. They have that kind of but they used to have a current account surplus. Now with higher commodity prices, it's kind of off and on. But they don't have like a big current account deficit in the way that say like the United States has, and that's one of the things that kind of keeps them stable. That's part of why they've been able to be stable longer than people think. And so they're kind of a nation of like major strengths and major weaknesses. So the terrible demographics, terrible public debt, and then it's kind of offset by some of these other levers that they've been able to kind of keep pulling in order to avoid any sort of like major crisis. But I do think that they're going to have much higher inflation on average going forward than people have been used to in terms of Japan.
Yeah, I would say it's a smart move by Mercedes or BMW or Toyota or Honda to build a factory in the country that you're going to sell the cars into. So the company is going to make profits. You're hiring domestic workers, but your home country then is not getting the jobs anymore.
Yeah, instead of getting the jobs, they do get part of the tax revenue, and their engineers and some of their other people still get the income from it. And so it's basically a way to try to augment their now their overall population is literally declining. And so again, they're not trying to optimize for number of jobs. They're basically trying to keep their current account balance like flat instead of like in the red. And so it really different countries are kind of optimizing for different things. And Japan's really not trying to optimize for jobs.
So I want to ask you about real estate. You talked about real estate being very interest rate sensitive. Bonds are also, so is corporate balance sheets, especially if they have a lot of debt and they have variable debt. Do you think that commercial real estate is going to be a lot worse off here in the United States than residential?
So I don't cover commercial real estate as close as I cover other markets, but it is an area that I'm concerned about, and it's part of the reason I don't really cover it too much because I don't. It's not really an area that I want to go long. I mean, there might be certain. I mean, it really depends on the sector, but in general, because we've had a big shift towards work from home, we kind of have these structurally higher vacancy rates, and then now you also compounding that problem is you have higher, you know. Financing costs on those properties that are not being as heavily used as they were expected to be when they were built. I do think that's a significant cause for concern, especially in New York City and a lot of those kind of office focused types of environments. It's not. It's
Well, yeah,
certainly not.
Silicon Valley too.
Yeah, exactly. It's not. It's not an area that I would want much exposure to.
And we're seeing this now with the real estate investment trust. So the ones that are commercial real estate focused the most, those ones are starting to cut dividends now.
Oh yeah, and some of them have had to not the REITs, but some of those funds have had to like pause redemptions, just because it's not a workable environment for them right now. Basically, tech and real estate are just the two areas that have really been squeezed by these higher rates.
Yeah, and the tech companies, I mean, they invented for many years, they got away with their own accounting metrics that were non-GAAP. And then as long as they could grow revenues or they could fool a pension fund that they had a new product or service and they were going to grow revenues, they could get away with it by selling more and more shares at higher valuations. But that game has stopped with the higher interest rates.
Yeah, and I think it's always going to be on a sector by sector basis. So there are some that cater to restaurants or cater to gyms, like kind of service oriented commercial real estate. I still think that can hang in there. I mean, obviously they're still facing the headwind of higher rates, whereas the danger zone is really in like that office type of space and some of those others where they're facing both the prospect of higher rates and that slowdown in demand, that higher vacancy rate. That's kind of the double whammy for them.
With these policies from governments and central banks and the currencies moving a lot, there's a lot of volatility in currency exchange rates the last couple of years, and then also the higher interest rates, because you're seeing other central banks start to do what the Fed has been doing with balance sheet reduction and raising interest rates. Do you expect a lot more asset price volatility going forward?
I do. And I generally think that inflation adjusted asset prices are just not going to do well for like 5 years or more. I think basically if you look at the S&P 500, especially if you look at an inflation adjusted basis, I think it's going to have a tough time surpassing that peak that it reached. And even if it marginally surpasses it in inflation adjusted terms, that's still over like a multi-year period. That's terrible annualized returns. And so I do expect some of these high valued, overcrowded areas of the past decade to be stagnant in inflation adjusted terms for quite a while. I think there are select opportunities elsewhere, commodities, certain value sectors, some of the stronger emerging markets. I think there are pockets where you could have good returns in the 2020s decade. But I do think that, especially as central banks try to tighten, as they try to, both raise interest rates and reduce their balance sheet, and as you have just, falling profit margins, higher interest expense for companies, higher labor costs for companies. I do think the days of just kind of like up only S&P 500 are kind of behind us because, during that whole period, you had rising earnings and you had rising valuations on those earnings. And now they're kind of in the opposite scenario. I mean, you have, nominal earnings can chop along, maybe grind higher, but you're not getting that ever higher valuation placed on them. You might even be getting a lower valuation in the years ahead. And just the overall profit margin's a lot more squeezed now because they're running into real constraints.
And also, I think this is going to be one of the most difficult environments because the traditional defensive ways that investors can play things by buying some dividend stocks, maybe utilities or some of these large cap consumer staple companies that Warren Buffett may have bought in the past. These companies loaded, a lot of them, tons and tons of debt onto their balance sheet in the last 10 or 15 years, really since 2008, because the Fed was doing zero interest rate policy for so long. So the corporate CFOs just added more debt. Not all of it was fixed rate debt. And so now you have higher interest payments, and then the consumer spending might not be as much. You have higher margin pressure with energy costs, higher labor costs in certain countries. So you're looking at potentially dividend cuts. Whereas like the traditional defensive metrics are play defense in this environment, look for dividend stocks where companies can grow their dividends. Well, we might see some of these oil pipeline companies, if they loaded their balance sheet with variable interest rate debt, not fixed rate debt, I mean, they could cut dividends too. So we could see a lot more dividend cuts than people think, depending upon how long interest rates stay at these levels.
Yeah, a lot of the consumer staple companies and the utilities are at pretty high valuations, and they're pretty loaded with debt. And so I think even they, like, even though they're the classic defensive plays, I think they're not going to be super attractive in the years ahead. Energy pipelines, it really comes down to the individual company. There are some, like, for example, Enterprise Products Partners. They've managed to avoid the blowups over the past several years. So they've been able to raise their distribution for, say, 25 consecutive years. I think their average debt duration is like 20 years. Basically, they're very heavily fixed rate and they're very long duration. So they've been able to lock in that lower interest rate environment. But not all of them are like that. And so really, if you do
I think Enbridge had to cut because I think they were playing the variable interest rate because they were betting the Fed would keep interest rates low.
Yeah, so it really comes down to company by company. If you're focusing on income, you have to make sure you look at the debt profiles of the companies that you're invested in to see how exposed they are to rising interest rates, both in terms of not just fixed versus variable, but even for the fixed portion, what is the average duration? And so you generally want to find ones that have locked in very, very long duration at the past several years of low interest rates, and now they're in an environment where they get to burn that debt away. But there's others, like you said, that are stuck with these higher expenses on their liabilities, and so they face more pressure.
Yeah, you have to look at the company, how much revolving credit, how much they drew from their revolving credit facility, if their debt is short term and they're going to have to go back to the bond markets now at these higher interest rates and sell more debt. They're going to start getting in some trouble. AT&T, which normally the telecoms are considered very defensive, although I think a lot of people are cutting back on their cable bills now. But AT&T has, for example, $130 billion in long-term debt on their balance sheet, and they only have about 16 million in annualized free cash flow. So you have a fight now with the shareholders talking about whether they should increase the dividend, whether they should stop paying a dividend and focus on paying down the debt. So it's just a mess right now. It seems like no one's going to be happy in that situation. And a lot of it's because of how much debt they have.
Yeah, I've so far been avoiding the telecom space. If I had to go with one, I'd go probably with the Verizon over AT&T. But I've just personally not been going into either, just in part because of that debt profile situation. I think there are more attractive, situations elsewhere.
So I want to transition now to energy. It looks like Germany is going to have to spend $1 trillion to fund a lot of their energy needs. They're really behind the curve. They've been booking, I think, a third floating liquefied natural gas facility. So do you think then, even though we had very high oil prices 12 months ago, it's corrected a little bit, natural gas prices crashed in the last couple months. Do you think that even though energy prices were high, there was still a lack of investment the last couple of years?
Yeah, exactly. There's not been a lot of investment. I mean, oil companies, in the prior cycles, they would just pour it back into the ground. This time, they mainly focused on capital returns, dividends, buybacks, paying down debt, not really growing the production too much unless there's just really attractive wells to do it with. And so I think basically as you have China come back online, they've had, for example, their domestic flights bounce back pretty quickly, but not their international flights yet. That still has a lot of room to go. And as you have, just other, just kind of rebuilding has to go on. I mean, you mentioned Germany. I think that's going to put upward pressure over the longer term on energy. I mean, in the near term, you had a warmer winter than average, so that kind of helped save Europe, and it also, basically just used overall less gas throughout the northern hemisphere. So that helped keep those prices low. You had the SPR drawdown. You have overall just slowing economic growth, which around the margins reduces demand for energy. Now that's being somewhat offset by the reopening of China. So I do think the structural bias for energy prices will be higher. That's obviously cyclically dependent on recessions and things like that. I mean, you can have periods of time where it consolidates or goes down, but I think that because of that tight supply side, the way I would phrase is whenever you have a period of growth acceleration, like whenever you have a rising PMI environment, you're probably going to get pretty uptick in energy prices, and only through recession or demand suppression will they be able to keep energy prices low. And even then, I think only for a period of time, because you could get that outright stagflationary scenario where you have weak economic growth, but the supply side gets tight enough that you still have rising prices.
And liquefied natural gas prices. So the international price for liquefied natural gas is way higher than the US natural gas price. So the futures contract here in the United States, the natural gas price, it crashed over the last couple of months. It was down around 2 at one point, which is way, way, way below the production cost for a lot of these natural gas producers. And a lot of them the ones that did have hedges didn't have hedged right. So the production cost for a lot of these American natural gas producers was above 3. So rationally, it wasn't going to stay. Anyone who studied commodity markets knows that if the price of the commodity is way below the production costs eventually, and it's not going to happen right away, but over a couple quarters, 6 months, a year at most, that eventually supply and demand are going to balance, or all the producers that produce the supply are going to go bankrupt. So I think we're seeing that scenario play out. It might take another couple quarters in natural gas, but if they can actually get the natural gas to a liquefied natural gas export facility, they can go sell it to Asia or Europe at sky high prices still.
Yeah, that's why we're also seeing more and more export capacity come online in the United States to arbitrage that difference. And I think over the long arc of time, you'll see that gap close to some extent because more and more North American product will be able to go overseas, and you'll basically have a continued growth of the LNG market, because obviously Europe has to rely more on LNG, and North America wants to sell more of their LNG, and so I think that's a trend that's going to keep continuing, and there are pipelines and certain producers that can benefit from that, but yeah, basically in the near term, it's obviously challenging for a lot of natural gas producers.
If our listeners go and research LNG terminals, go and Google it, there's a lot of countries that are planning to build now liquefied natural gas import terminals. There's a few that are planning to build a lot of export terminals, but there's still a lot of natural gas, oil and natural gas drilling bans in a lot of countries. So these countries don't want any domestic supply and domestic drilling. They want to import the liquefied natural gas. So there is an opportunity there, and liquefied natural gas and natural gas demand will continue to grow, because I believe, Lyn, other than nuclear power, natural gas is kind of the compromise between coal and other forms of energy. So natural gas is a cleaner compromise there as we transition to maybe more efficient forms of electricity, the next generations of nuclear power.
Yeah, I mean, if you look at a lot of just overall global energy usage, natural gas is still firmly in the uptrend. Until recently with the LNG, the Russian gas and LNG issues, generally natural gas has been one of the cheaper forms of energy. Like you said, it's one of the cleaner ones compared to coal, compared to biomass, things like that. And so it does make a lot of sense. And there's still overall more production that can come online and more infrastructure to arbitrage some of these different price differences. Because oil is a more fungible market. It's easier to transport oil. And so you generally get smaller price differences between oil in different parts of the world. Whereas natural gas, because the transporting is such a big component of it, we get these really big differences in terms of geographies. And I still think there's a lot more work to be done to make that more, basically there's a lot of global arbitrage to do in terms of finding ways to get the cheap gas hooked up to the rest of the world where it's more expensive. And I do think that the combination of nuclear and gas is going to keep rising in the years ahead in terms of demand and in terms of changing public policy around energy security.
The problem with these liquefied natural gas import and export facilities is they cost many billions of dollars. And so if you're a private sector company, so if you're a small cap company like a Tellurian, you were looking at funding 18, 24 months ago at a much lower interest rate. So you're doing all your cash flow projections, your cost of capital, your interest payments on the debt if you borrow debt to build your liquefied natural gas export facility. And then all of a sudden the Fed's hiking interest rates. So now your cost of capital to borrow debt is just astronomically higher. You're above junk bond rates. So a lot of these liquefied natural gas facilities, unless the governments are going to pay for them or subsidize them, they're going to be delayed a while, at least a couple of years.
Yeah, and whenever that happens, I mean, it basically allows those arbitrages to exist for longer, and slows down any sort of supply response. I mean, basically, if I were in charge of one of these like European countries, I would do my best to finance North American export terminals, basically to try to alleviate that supply side. Or
if you're an existing player, so if you're a Cheniere Energy, and that's why the stock is holding up so well. So if you're a Cheniere Energy and you're already cash flowing, you already have all these long-term liquefied natural gas contracts at enormous profits. You're just doing deal after deal every month or two with China's national oil companies or Canadian firms. You're just getting all these deals done. Whereas if you're a small cap player and you need to borrow a bunch of debt at a higher interest rate, you can't get any funding right now. So the Cheniere Energies are really, really benefiting.
Yeah, no, definitely. There's certain pockets that are able to make a opportunity out of this, and it's also even some of the other pipeline companies, the ones that are kind of stable and profitable, and they have that fixed rate debt. They're able to gradually increment their either their export facilities or their connections to export facilities, and keep kind of gradually benefiting from that.
And the US is projected, I think, by early 2030s to double their liquefied natural gas export capacity. So maybe that number goes down a little bit if interest rates stay high for another few years. But if interest rates go back down, I mean, I think a lot of these liquefied natural gas export projects are going to get funded then.
I agree. I mean, it's clearly a source of ongoing need, and I mean, so many policymakers and lawmakers, when they see inflation, are focused on the demand side, whereas in many of these cases, it's a supply problem. Like, for example, Europe needs more reliable, foreign natural gas, and North American exports are one of the ways to do it. And so, basically, everything that they can do to try to close that gap makes sense from their perspective. And so I do think it's a trend that's going to continue.
Are you surprised that copper prices have held up pretty well? Because I know a lot of people were super bearish on copper. It had a correction for a couple of months and then it had a very, very strong rally.
Mildly. I mean, basically, copper historically does not do well in economic decelerating environments. But I've been following some of these like shortages and things like that. So I've been kind of neutral on copper for a period of time. I'd like to see a re-accelerating economic environment to be super bullish on copper. But I'm not like shorting it or anything like that either. I mean, basically, I think the long-term case for copper is very bullish. And these shorter term things are determined partially from demand, which is not super strong at the moment, but the supply side is still very, very tight. And so it's held up pretty well compared to what you'd expect from, for example, if you map the gold to copper ratio over purchasing managers index, normally those are quite correlated, like sine waves of economic acceleration and deceleration. And really in the past several months, kind of the second half of the year for 2022 and since then, you've had copper doing quite well compared to what you'd expect from that slower economic environment. So yeah, I've been somewhat surprised the upside, but the more I kind of keep tabs on what's happening with the supply constraints, I'm not that surprised.
I also think the market's betting that all these governments out of the West, the ones that are talking about electric vehicles, banning internal combustion engine cars, nonstop repetition out of the Davos crowd. So these Western governments and large corporations about ESG policies, there's not enough copper right now for lots of people to switch to electric vehicles. Same thing for silver. So if they're going to force us to transition to electric vehicles, that's going to increase copper demand, and there's a lack of supply too. So this is going to benefit a lot of copper miners in the long run then.
Yeah, a lot of people don't pay attention to details of like the grid and other things like that. So for example, if things are going to be a lot more electrified, so many places need way like more robust electrical grids, which is going to mean a lot more copper. In addition, India, for example, is still going to be expected to be a massive growth source for copper demand. They still use way less copper per capita, and they're still rapidly growing. And so basically the combination of select emerging markets as they increasingly industrialize, and the combination of just the need to overhaul the grid and around the margins electrify more. I think that obviously the long-term case for copper is quite bullish.
I think also you're starting to see supply concerns for silver, although the paper silver price has been weak the last month or so. I think over the next couple of years, you're going to see this play out because you're starting to see supply come offline for silver in Peru and Mexico, which are the two largest countries for annual silver production. So I think that's going to be bullish long-term for silver as well.
Yeah, I think one thing you generally see in commodity bull markets and bear markets is you generally see most of them move together. Obviously, you can have some idiosyncratic differences, shifts in timing, but generally a lot of these capex cycles go in unison. And so, for example, the 1990s was like a commodity bear market. The 2000s were a commodity bull market. The 2010s were a bear market. I do think the 2020s are going to be generally a bull market, and I think that rising tide will lift most boats. I mean, basically, you have shortages around a lot of them around the same time, and you'll basically need to see see new capex in a lot of them, which only comes when prices justify. Basically, they stay elevated and for quite a while in order to justify new production. And then you have that lag between the need for new production and that production actually being able to come online and start producing. And so I do think that, having diversified commodity exposure does make sense for this decade.
So for the rest of 2023, I know you put out articles on this for predictions for 2023. Is there anything you're optimistic about for 2023 or any bullish companies or sectors?
So I think select pipelines that have that long duration fixed debt. So you have to know the names you own. But I do think that there are some interesting areas there. A lot of investors avoid the ones that issue K1s. But those are actually the ones that are kind of at more attractive valuation. So if you're looking to hold for like a multi-year period, I would start looking at some of those. I also think that some of these, some healthcare stocks are still decent. I'm kind of longer term cautiously optimistic on India and Brazil, even though obviously they have risks. I think that I'm less bearish on banks than the average person seems to be, in part because that dynamic we talked about of the Fed, like basically losing money, a lot of where that money is going is into the financial sector. Basically, banks are being paid very high interest on their Fed deposits, and it's a much larger interest spread compared to what they're paying depositors. And so banks, I think, are in decent shape. Obviously, you want to avoid ones that have an oversized commercial real estate exposure or that have like a lot of auto loan exposure. But for most pretty large banks, those are pretty small percentages of their loan books. And so you really have to know what bank you own. But overall, I'm less bearish on those. And then just in general, I like commodities and other scarce assets, as well as, assets like Bitcoin. Basically, it's just an overall strategy of owning what is scarce, avoiding what is abundant, and having some cash liquidity to rebalance into any sort of moments of weakness or major liquidity crises that happen. Because you can get, counter moves that drive prices really low, and then you can rotate into them, which, if someone's over levered or if they're already like all in, they have trouble taking advantages of those sell-offs.
Yeah, I think those are good strategies. And then keep cash on hand too, in case there's opportunity. Don't go buy all your stock position at once, because I know people read some of these articles about companies that are undervalued and they go and buy their entire stock position at once. And that's a big mistake.
Yeah, it's good to generally layer in. And a general strategy I've had is kind of separate between income and non-income. And so on one hand, I want to own a number of income producing assets that just constantly, just generate this cash flow. And then on the other hand, I want to own, scarce assets, things like gold, for example. They're not paying a cash flow, but they're things that I expect them to appreciate in price, and that more people are going to want to hold them in the future. And so by maintaining both, by not having leverage, and like you said, by having cash on hand, by having that available liquidity, you can get through, kind of challenging environments.
So, Lyn, I want to thank you so much for your time today. I really appreciate it, and hopefully we'll have you back on again the next couple months.
Yep. Happy to be back, and thanks for having me.